banking number 3. So what we started doing is the assets of commercial banks. And from last time, the first asset that a commercial bank maintained is cash. And it was just said that cash is used to serve deposits, deposit withdrawals. We sometimes call these redemptions. And it serves to satisfy minimum reserve requirements. The second piece which we said was bank loans. And from the loans part we mentioned, let's see what? We mentioned from the loans part working capital loan to satisfy working capital needs. The next, which was also called self-liquidating loan. The next one were term loans. We mentioned about typical protective covenants. We mentioned what amortization means. Let's write out the concept. Amortization is, in terms of a loan, the pay down or the reduction of a principal of a loan. Pay down of a reduction of a principal or the value of a loan. And let's clarify a concept and the difference from elementary accounting. Depreciation is the loss of value of a hard asset or real asset. Depreciation is applied to tangible assets or real assets, and amortization applies to intangibles, and both refer either to the economic value of an asset, or in accounting they will refer to the book value of an asset. So amortization will be the process by which the book value of an intangible asset is reduced. Alright? So this was about the loans. We mentioned a balloon payment, which is a significant payment at the end, of a loan, which involved a significant percentage. And we mentioned a bullet loan. Alright, so the next one, did we cover direct lease loan?
Yes.
We did. So, direct lease loan is simply a loan to a commercial bank, to a commercial enterprise, by which actually the commercial bank loans out the funds and actually kind of like loans it out to itself and acquires by becoming the owner of the, let's say, the truck, and then leases the truck to the commercial enterprise and uses a long-term lease. So the bank loans out the money to itself, purchases the truck on its own name, maintains the truck in its own name, but leases it, let's say, for 5 years to the commercial enterprise. And this is equivalent as if the bank provided a 5-year loan to the enterprise. They would like to do the lease for a number of reasons. The first reason is the bank is better secured when the asset is in its own name. Sometimes...
Collateral, is it a kind of collateral?
Yes, it is a collateral, but in this case it's better than a collateral. It is in their own name. When you have a collateral, the idea is that if you don't pay,
they take it.
Well, when I say they take, it's meant that you use the judicial system to acquire the title of ownership, and once you acquire the title of ownership, you repossess the assets. If you actually own it, you save yourself the legal procedure. You literally go and take it when you own it. It's kind of like if it's a car, just take the keys, you get inside the car and say, hey, the car is mine. Right? So That's the idea of a lease. The second idea of a lease will be a tax rate differential. If I'm paying, let's say, 5% tax, that's we call this a tax bracket. You know what's a tax bracket? The marginal tax bracket. Let's do this. Marginal tax bracket. Alright, so bracket means that, let's say, I'm just providing an example. From 0 to 10,000, you're paying, let's say, 5% tax. From 10, I'll just use K, to 20K. From 10,000 to 20,000, you're paying 10% tax. From 20,000 to 40,000, you're paying 20% tax. Let's say from 40,000 to 100,000, you're paying 30% tax. And any revenue or income over 100,000 will be taxed at 33%. All right, 0 to 10,000 is the bracket. All right, is the tax bracket. 5% we call the tax rate. And marginal tax bracket refers only to the last income. So if you're at the $60,000, then your marginal tax rate will be respectively 30%. The marginal tax bracket will be 40 to 100,000, so 30%. Well, if you have a machine or an equipment, a truck, which is purchased and leased, the owner, that's the key, the owner of the asset, in other words, the entity which has the machine on its accounting books, has the legal right to depreciate it for tax purposes. So, if the business has a, let's say, $15,000 income, in other words, it's a new business, not very profitable, it will have a marginal tax rate of 10%. It will get effectively a tax shield. It's this one. It will get effectively a tax shield of 10%. If the bank is very profitable, mature business, it will be paying maybe 30 or 33% tax, all right? So, if the one entity, let's say you get a $1 million crane, and the one entity depreciates it, it will, at the 10% tax, save $100,000, all right? The other entity, at 33% tax, will save $330,000. So if the bank depreciates it, it will gain a tax shield, an extra or additional tax shield of $230 saved. Well, when you have these tax gains, we properly call them tax savings, all right? Now the two parties can share those gains between themselves, all right? So it is profitable to have the owner to be the entity which actually has the higher marginal tax bracket, all right? And it will share part of the gains with the other party. And this is one of the real financial reasons for maintaining a lease. Now, leases are capital lease, operating lease. You'll study these in either intermediate accounting or corporate finance. You usually have a full chapter on that. Now, let's do the following two. This was all review. We continue now with the two concepts of informal line of credit. Informal line of credit. And the next one is revolving credit loan. So, revolving credit, sometimes revolving credit loan. Alright, what is a line of credit? Well, a line of credit is simply a facility provided by a commercial bank to a customer, usually a business, could be possibly even an individual. And the informal piece, which is key, means that the commercial bank has no explicit commitment and legally is not obligated to provide the loan. So, it will have a long-standing relationship with a particular business, and that long-standing relationship, say, okay, you've been a customer for 5 years, you've been a good customer, will give you an informal line of credit up to $1 million. So at any point in time, you can come, you can borrow $10,000, $50,000, $500,000, $750,000. You use it the way you want to use it. Usually, within a line of credit, one of the advantages is that you don't have a payment schedule, fixed payment schedule. Kind of like works exactly like a credit card. You typically have only a minimum payment, could be, let's just say, 1% of the outstanding balance, and you can pay as much as you can, or as you want, or as you wish, as long as you have the cash. So, you borrowed $500,000, the next month you generated some revenue, you can pay down completely in full, you can pay $400,000 or $300,000 or only $50,000 or maybe even only $5,000, which is 1% of $500,000. The informal part means that the bank does not need to secure available liquidity in case the customer walks in and says, I need $1 million. And the bank has a firm commitment. In this case, the bank doesn't. In the second case, the difference is that the bank actually does have revolving credit loan. Now let's explain this part. When the credit crunch arrived, and suddenly credit is extremely hard to get, the whole banking system came into this absurd situation where it's damn hard to get credit, yet credit outstanding skyrocketed as if this is the wildest credit boom in history. How was this possible? How did this occur? Let's say, well, there is no credit crunch. You know, how could there be credit crunch if credit is accelerating in the banking system? And the answer is, everyone, all businesses, understanding that there is a credit crunch and anticipating tightening credit, they went in and cashed out all outstanding credit facilities. They cashed them in order to accumulate cash reserves in anticipation of having difficulties borrowing 3, 6, 9 months down the road. So, you already get a credit crunch. Banks don't lend to each other, meaning banks at that time, Lehman Brothers and all this kind of stuff, lost confidence in each other. Banks are in deep trouble, and all customers rush in a classic form of a bank run. They went in to cash out. Now, bank run involves a deposit that you already have. This case is a loan commitment. A loan commitment. And the customers went in, and this made a bad situation of the credit crunch itself a whole lot worse, because suddenly the banks were overwhelmed by liquidity demands. Alright? So, when banks provide especially a revolving credit loan, meaning a loan, what they do is they say, okay, you get a full $1 million of a loan if you have $1 million, and if you use $10,000, you pay the normal, regular interest rate. For the rest, which you don't use, you pay a minimal, symbolic interest rate. Alright? So, the first one we call used funds. So when they give you a 1 million loan, you use up only 50%, oh sorry, only 50%, half a million. You call these used funds. These are the funds that you actually withdraw and actually used. The other funds are called unused. Unused funds. These are funds from a revolving credit facility or a loan that you didn't actually withdraw. Well, you didn't use them, it doesn't mean you're not going to be paying on them. But you're going to be paying 1% interest. This is, you're paying 1% because you're tying up bank liquidity, that the bank liquidity is standing there available for you, and the bank has an opportunity cost of not being able to use the bank liquidity that you tie up to somebody else so that they can earn 7, 8, 9 or whatever the interest rate is, the current interest rate is, okay? So they're just making 1%, but the money stays safe in the bank. Alright, so used funds, unused funds, and you have what banks love, remember from last time?
Right.
Banks love fees. That's what they live off, right? Commitment fee.
The same as commission?
No, not the same as commission. Commission is a charge or a fee, revenue, based on a particular transaction. It's a percentage of a transaction, usually associated with a sale. You sell a car and the car dealer gets a commission. A broker, real estate broker, intermediates a buy and a sale of an apartment, he gets a commission. Commitment is something very different. When you marry somebody, you commit to that person for the rest of your life. Means that you engage, well, that's what they call it, engagement, right? Before you get married. You engage that you will do something in the near or a distant future, and that you're committed to it. Meaning that you are legally obligated to do it in the future. So the commitment involves a legal obligation to do something in the future. Well, if you will be obligated in the future, then this is worth money. So, I have made, when I signed my contract, a commitment to teach for 12 months from September 1 till July 31st, 2009, to teach so many courses at such a salary. So I have a commitment. When I start the semester, I have a commitment.
But what's the commitment fee?
It is simply the fee paid that somebody has made some commitment for something. If you will promise somebody that you will do something, alright, that is, you made a commitment.
In a bank.
Well, with a bank, the bank already says, if you get in trouble, I'll give you 10 million. So, the commitment is, let's provide it in a very different way. Let's provide it in a very different way, is a call option. Is a call option. So, the commitment means, if you need the funds, I'll give them to you. Up to 1 million, up to 12 months from now. This is the same as the bank provides a call option, and the call option has a value. In other words, the fee will represent for the bank the value of the call option which the bank collects. Alright? And this is the unused portion. The used portion is as if the bank, or actually the customer, exercised the call option. Alright? So, it provides up to 1 million, and used funds, you exercise the call option, you're paying the full price. You don't exercise the call option, you're paying only the premium. Well, but they just call it a fee. Alright? That's usually bankers speak, everything is a fee, right? Alright? So, That's the commitment fee. So when they charge the customer, they charge the, did I cover last time the prime rate?
Yeah.
So the prime rate is the interest rate which a financial institution charges a creditworthy borrower, a highly rated borrower. We call those borrowers, if you remember from last time, from many times ago, prime borrowers, all right? Prime borrowers are those of high, good investment quality. And those borrowers that are not of high, good investment quality, we simply call
Interest rate. No.
subprime. Subprime means they aren't quite perfect. They have some credit history and credit problems from before. They aren't great, but they aren't terrible either. They're just much higher risk. So prime essentially means of relatively low credit risk, and subprime means
High.
of relative. We don't say high.
Relative.
Well, high, what does it mean high?
Relative.
50, yeah. We say relatively high, all right? So relatively low, well, for example, will be 1-2%. Relatively high will be 4, 5, 6%. For subprime mortgages, the built-in models used 4 to 6% default rate. And they used 90% recovery rate. Did we discuss recovery rate last time? No? We never did? Okay, this is another banking concept from risk management. Let's do this. I'm jumping a little bit here. Default rate. Then you have recovery rate. Default rate simply says if you have 100 customers and you lend out money to 100 customers, how many of these you're going to collect without any problem, without any default. So the default rate will be only those that will become problematic one way or another. So default rate will be the percentage of outstanding loans that will have a problem within a particular period of time, all right, that will become problematic. A different way of saying it, which is a completely different measure. Now, one measure is within next year, out of 100 customers, 5 will blow up on you, meaning they'll default or will become problem. A completely different way of thinking it is, out of all my current customers, at this moment, I have 75 customers, 3 got problems, and 72 are in good standing. All right? So, one way to think about it, out of my currently good customers, how many will go bad within the next 12 months? The alternative is, out of all of my current customers, how many are good and how many are bad? All right? So, the default rate will represent the percentage of the customers, but it's got to be actually of the outstanding balances, which is in some sort of a default. All right? Now, the recovery rate represents the amount of money that the bank is able to recover as a percentage of the outstanding of a bad loan. All right, and then we have finally the so-called loss rate. This is the amount of money that the bank loses on average on a loan. So, suppose the default rate for subprimes was 10%. So, you provide 100 subprime loans. Out of these 100 subprime loans, you expect 10 to go bad and 90 to do fine. You also provide a recovery rate of 90%. They say, well, no big deal. Even if default rate is high, we're going to be losing literally 10% on the bad loans, and we'll be losing nothing on the good loans, right? So the recovery rate is 10%. So if the default rate is 10%, this means that only 10% will go bad. And of these that go bad, you will actually recover 90% through foreclosure, and you're going to lose only 10% of the money. Alright? So the actual loss rate is how much? Anyone with elementary math? The loss rate?
10.
No. 1%. Only 1%. Let's do the math, right? We need to do the math. Alright. Suppose the following happens. 10 customers, and out of these 10 customers, each will have 100,000 mortgage. The total amount is 1 million. Alright? So, out of these 10 customers, how many go bad according to these assumptions?
10. Sorry.
Out of 10 customers,
1.
1 goes bad. So, 1 is bad, and what is going to be the loss on that one customer? On that one customer, what's going to be the actual loss? You lend him out 100,000, you recover 90%, which is 90,000. So you're going to lose on this particular customer only 10,000. So becomes 10,000 loss. So the loss rate will represent the 10,000 actual loss divided by the original outstanding balance. So when you divide 10,000 by 1 million, it is 1%. Alright? It is 1%. So the loss rate is, in this case, 1%. So what the bank would typically do is charge a risk premium of a little over 1% to compensate itself for the risk of loss, of default. Well, what happened in reality? In reality, default rate wasn't. Now, let's change the numbers a little bit. They assumed default rate of 4 to 6%. So let's say default rate was 5%, and recovery rate 90. That's what they assumed. What's the question?
What about provisions?
That's a whole different story. I'll explain it in a minute. Let's just finish this and I'll explain the provisions. So, default rate turned out to be, guess what? 25%. And on subprimes, what's the recovery rate? Recovery rate turned out to be 50%. So, what banks did is they underestimated the default risk 5 times. 5 times. So, they got it wrong 5 times. Well, what about the recovery rate? What about the loss per bad loan? They underestimated it again 5 times. Let's explain 5 times. If you are going to be, recovering 90%, this means that the loss is only 10,000. But the actual loss now we are observing is not 10,000, it is 50%. So out of 100,000 loan, the actual loss is 50,000. So instead of 10, it's 50,000. So they made an error of 5 times on the default rate and on the recovery rate 5 times. So they made an error of 25 times. 25 times. So if they were pricing their risk correctly, and if the risk-free rate was 5%, they should have priced these loans at 30% to cover their risk. If they charged, instead of 5, 7, in other words, they charged only 2, instead of, let's say, much bigger amount, they effectively underpriced risk. Alright? So, this is where the problem with subprime is. The subprime, they first underestimated significantly by 5 times the default. They underestimated the other one, and losses turn out to be 25 times, no, times bigger than they originally expected. Well, they probably expected them to be a lot bigger, but when they were selling them, they were selling them with 25% or 25 times less risk than they usually had. So this is the default rate. Now you're asking about the provisions, right? So what is a provision? Any clue?
Yeah.
Ah, okay.
It's the amount that they think that they're not going to recover.
Okay, no, this is not the amount that they're not going to recover.
They put it as a...
Ah, okay, so one of the verbs that we use, we say, because you say put it, we call set aside. Set aside. So, this is the amount of money which a financial institution, we say, provides or sets aside as an expected loss from a loan made in the current period. So one of the for the whole loan, for the whole life of the loan. So one of the fundamental principles in accounting is that if you're doing something in the current period, whatever revenue you recognize in the current period, you must match the corresponding expense in the current period. And what the provision does is it allows for certain gains or certain profits or certain revenues. And if you provide for certain revenues coming out of the interest revenue, you must provide expenses, which is the interest expense, and the loss. Well, in this case, the provision is for losses. We call these properly and technically loss provisions. And a loss provision simply provides the expected value of the loss. And in this particular rate, the loss provision will be equal to the loss rate multiplied by the current outstanding, the increase in the current outstanding. So, in other words, we provide this month 10 million new loans. For these 10 million new loans, we have, and now this is not the loss rate, this is the let me do this. I'll write it here. Expected loss rate. So, when you're providing the loan, you expect a loss, a default rate of 5 and an expected recovery rate of... So, you have an expected loss rate of 1%. If you have an expected loss rate of 1%, then on a 10 million of new book, meaning new loans, you will allow immediately as an expense, actually as a loss, you will allow 1% of 10 million, which is $100,000, all right? So this will be your expected loss, and you will provide a loss provision of $100,000, all right? This we call expected, and this we call actual. Actual or realized, yes, actual or realized, all right? And when the bank provides for a certain loss, then based on the actual, the difference when it's realized later must be booked. So when there's an extra loss, they will have to write down and provide extra losses, all right? Or when they've provided more than the actual losses are, they will have to book these extra losses that was originally booked. They'll have to reverse them, and now the losses will become gains. All right? So you had a 10 million book, you allowed for 100,000 losses, but if the actual losses are only 70,000, the 30,000 which you did not realize as a loss becomes effectively a gain. All right? You put it back. Sometimes you call it reintegrated, but to reintegrate is a tricky concept because it involves, it's part of the capital. You have some gains. You have some. I don't want to get into that reintegration. It's complicated. This is subprime. Is that fairly clear so far? Questions? No. All right. Let's move on. All right. The next thing that bankers do is loan participations. Didn't I cover this last time?
Yeah, loan participations.
Yeah.
And you gave us an example, syndicated loan.
Yeah, it's kind of like a syndicated loan. So a loan participation is a bank will participate in a bigger loan because the bank is not willing to assume the full loan or to assume the full risk for the loan, and the bank will be willing to share both the revenues and the expenses and potentially the risk, in other words, the gains and the losses, with 5 other banks. And one of these banks we call the lead bank. The lead bank.
Is it the same as mandate?
No, I don't know what's mandate. Alright, so let's clarify what's the lead bank. This is the bank which arranges and organizes the loan and does the legal paperwork, the disbursing, and does the whole work with the customer. And later on it services the loan, so it also becomes a servicer. The other banks are called participating banks. Now, banks, plural, because usually you'll have, it's not going to be 2, it's going to be 5, 10, 20, depending on the size. So you're going to have participating banks, and participating banks communicate only with the lead bank. So the lead bank acts as a coordinator, and the lead bank will usually get a much higher share. Usually the lead bank will be big, Citigroup, HSBC, whatever. It's going to be Deutsche Bank, right? So it's going to be, let's say the lead bank is going to take 20%. It's going to pick up 8 other banks, and each will pick up 10%. Now, the key in a loan participation is that the lead bank does not assume the full risk. In other words, participating banks share in the risk on a pro-rata basis. It simply means whatever the losses are, if you financed 5% of the full amount, you're going to be sharing 5% of the losses and 5% of everything else. Alright? If you made 50%, you're going to be sharing 50%. Alright? So the lead bank, there is no transfer of risk from participating banks to the lead banks. Everyone shares. Alright? But not equally. Percentage-wise from their participation. Alright, so the lead bank arranges for documentation, for the disbursement, for the payment structure of the loan, and for servicing the loan, collecting from whatever, foreclosing, doing everything else, and then distributing back to participating banks their shares.
Is this the same as the escrow account?
No, nothing to do with an escrow account. It's a completely different story.
Don't they collect? It's the same many banks get.
Well, yeah, they may have an escrow, yes. They will, it's not the same as, they use an escrow account. So, when they take the money, they first put all the money in an escrow account, and then the money will be distributed from the escrow account to each member. In other words, when they collect the money, they'll first book the money in one big account from the customer, so the customer will have an escrow account, and then from that big pool, the escrow account will be the big pool account, they'll take a slice and give it to each member, to each participant, alright? And the lead bank will keep its own share. but that's a different, I don't want to get into that's a little bit, escrow accounts, these are accounting techniques to keep track of things, all right? Whether you have an escrow account or you don't have an escrow account, it does not change the financial side of things. The financial side is not changed. Only the accounting and bookkeeping, tracking of the stuff. All right, so what the lead bank would love to do, and they of course do, is we call these servicing fees. Servicing fees. So the lead bank will charge participating banks servicing fees. Well, they could be relatively small, they could be relatively large, but they're going to charge something for the time, the effort, the paperwork, tying in bureaucracy, bankers, etc. All right, the next one we move on is, I got some memory from last time, we did LBOs, did we? Yeah, we did LBOs last time. So, let's do LBO is a leveraged buyout.
Yes.
All right, so we did LBO, leveraged buyout, usually involves management. In this case, will become MBO, management buyout. So management or someone else, some other third party, will acquire a significant amount of shares in the corporation and usually will attempt to retire all outstanding shares and make the public company private again so that its shares aren't traded on the market. Or they may attempt just to buy out a significant, we call it controlling percentage of the shares so that they can take control. Well, if you're going to be acquiring a $100 million company, usually to buy back some or all of the shares, you'll need a big loan. 50 million, 80 million, 90 million. So banks will provide these loans to acquirers, okay, acquirers. Sometimes we have takeovers and other stuff. So these particular types of loans we call, do you remember from very early on?
Leveraged loans.
Leveraged loans.
Bonus point.
Leveraged loan, okay, so a leveraged loan is a loan that is used to finance a highly leveraged transaction. One of these is, an example was an LBO, MBO. There's possibility for mergers, acquisitions. I don't want to get into the detail of those. All right. Did we mention last time junk bonds?
No.
I know what's a junk bond.
All right, tell us. Let's see. Tell the world.
The junk bond is the bond that has a very high risk of default.
Okay, it is a very high risk of default. So we first begin that it's
very low quality, like not.
Yes, very low quality. So first I will begin that it's a corporate bond.
But it has a high return.
Yes, it is a corporate bond that has a high risk and high return. So it's a high risk, high return bond, usually not of investment grade.
Yeah.
So usually ratings, let's do a rating. Ratings go in two different types. The first one, well, let me use red. Investment grade.
Under
Investment grade, which is a high quality borrower and is associated with low risk, meaning relatively low risk. And the other one is non-investment. Non-investment grade, which is known in the industry as junk. All right? Well, during the Michael Milken, junk bond era, blah blah blah, junk bonds were booming and everything was else. The lesson learned was that eventually the whole junk bond thing blew up big time and hurt everybody who got themselves into the junk bond business, especially on the investing side, not on the financing side. And the lesson learned was that during the junk bond years, all throughout the era, because there was a big major credit boom, the main problem was under appreciating risk or underpricing risk. In other words, they were pricing again a 10% default rate, but when times got bad, the default rate from 10% was many times bigger. So the problem with the junk bond is that usually risk got underpriced, which is identical to the subprime. So problems in the economy, in the banking system, occur in one form or another when risk is underpriced. Financial engineers and the bankers' job is to find an instrument with which to wrap up and package the risk and being able to sell it by essentially convoluting the risk so that the buyer, the pension fund, doesn't understand what the real risk is. Right? You're trying to sell a lot more risk than it is. All right? Understand that part? So, in every era where there has been a bank blow-up, there has been one form or another underpriced risk. And when risk is underpriced, usually market participants will make or assume a lot more risk. When it blows up, the market participant blows up. Is it time for a break? Huh? Yeah? All right. Well, junk bonds. Let's see what's next. We call these, let's try to do this. Wow, it's turned out that it's only red because I'm covering concepts. Highly leveraged transactions. These are transactions that involve little equity and a significant portion of debt. Now, this simply means that you have, we call this financial leverage. So anytime you have a high degree of financial leverage, you have a correspondingly high degree of risk. Risk. Yeah. So debt equates to risk, meaning that debt is a cause of risk, and higher debt means higher risk. Alright, so now what is one of the latest trends in banking? It is not an instrument. This is important to understand. I've been talking about different types of loans and loan facilities. One of the trends, it's a little bit tricky, but it's a brand new section we're talking about, is now that as a trend, banks have begun to accept intangibles as collateral. In other words, many of the U.S. businesses being transferring or shifting from purely manufacturing to services, including financial services. And even though you may have a manufacturing like a pharmaceutical company, part of the value of the pharmaceutical company are its tangible assets, but a significant portion of American industries, the value in American industries, is based on research and development. And research and development sometimes provide trademarks, sometimes provide patents. In general, they create or generate certain intangible assets. So, as higher and higher percentage of American businesses will have a steadily rising percentage of intangible assets. In order to secure more loans and financing, businesses will pledge as a collateral those intangibles. Well, in the early days of banking, bankers would not trust intangibles. They would want to have a hard asset that they can get their hands on. All right? Well, recent trend in the last couple of decades has been that bankers have become more willing to accept intangible assets as collateral. All right? This could be the brand name. This could be the formula of the miracle drug that will get a fat person skinny again. All right? Well, if you knew that formula, you'd be a billionaire. Well, that formula would be worth probably billions or tens of billions of dollars if anyone had the patent and full control over the formula. All right? Therefore, whoever has the formula, formula itself represents an asset, an intangible asset. All right? All right, let's see what else. There has been a new trend in banking called lender liability suits. So let's explain this as a trend. Lender liability suits. Okay.
We have a lender liability on business loans. We have it as a lender liability on business loans.
Yes, what they have? Lender liability. Okay, I have it suits. Okay, so what is a suit? Well, suit is just a legal procedure initiated by a party, because he believes that he's been in one form or another victimized, in other words, that suffers some sort of losses. So in this particular case, it is the borrower who sues the lender that the lender caused or created some sort of a damage. The typical type of a damage that the lender created or caused might be, number one, it promised it was going to give some loan, but later it didn't give. Or enforce certain clauses, or in other words, the lender either didn't perform well or was too stringent on the borrower. For example, lender lends some money, let's say to a farmer. Okay, for 5 years you can buy the land, 5-year loan, blah, 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 whatnot. Then the farmer, got his crop. He was able to pay, let's say, 70 or 90% of what he promised to pay, but the lender went on and enforced, let's say, foreclosure. So you could get all sorts of little things. The biggest one, which the textbook mentioned, is that the lender provided some sort of a short-term revolving loan and terminated the loan without sufficient notice, causing the borrower a financial distress with little time to be able to refinance from another party. All right? So that's where the problem usually is. The problem is, pay the money back next week. Well, how do I pay the money back next week? How do I pay $1 million back if I'm a small farmer, right, with 200
Don't
cows?
they do something called cash cycle?
Well, that's a cash cycle is a completely different.
To know how much they should lend him.
Yeah, yes. So you should understand, if you're a lender, and of course when you're a borrower, you should understand your own cash cycle. So some seasons you have high cash revenues, for example tourism, and some seasons you're going to have low. So you should attempt to time and schedule payments so as to match as close as possible your cash cycle, right? The idea is that when you have a season with extremely low cash flows, which are easily forecastable, for example, agriculture or tourism, so you have seasonal cyclicality, of course you would naturally don't want to have high payments when you expect cash flows to be low. Right? Let's see what's next. You also have now a whole bunch of consumer loans. Let's clean this mess and continue with some consumer. All right, so this is a huge section. Consumer loans.
Professor, why are there a lot of terminology?
Well, one of the reasons is because the nature of thing is complicated, so you need a lot of terminology because you have a lot of different concepts. The second reason is that a lot of times when a concept is well understood what it means, and especially customers and people and bankers, practitioners, lenders, investors get to understand that, whatever the concept is doesn't really work well for them or was bad in the past, kind of like blew up in the past. Bankers, especially investment, devise and create a brand new term to put to an old concept so that they can intentionally confuse customers. Alright? That's part of what bankers do. In other words, confusion. So, consumer loans, bankers love consumer loans. Why? They are very, very, very profitable.
Yeah.
Why?
Because
No, because consumers aren't very sophisticated
Yeah.
borrowers.
Yeah.
Most of the times, they don't know what they're doing. Most of the times, they don't understand the real financing side of it. Most of the times, it's very easy to tell them, oh, your loan is only 8.75, 8% 75, but bankers put in one fee, second fee, third fee, fourth fee, where the effective rate from 8.75 becomes 15, all right? So, in other words, it's very easy for bankers to rip off retail customers.
Yeah.
It is also very easy to abuse them because bankers got big law departments and big law firms, and individuals, retail customers usually are defenseless against the big banker society in general. So, if bankers can abuse them and make a lot of money out of them, they will. And this is exactly what has been one of the most important trends over the last 20 years. When you have the American consumer society, well, what fueled consumption when the consumer society were consumer loans. Bankers are behind the transition to a consumer society. Alright, so number one is installment loan. Installment loans, sometimes spelled with one L or double L, British English, American English. So this is simply a loan, usually paid back in
installments.
Yes, in installments, in other words, in equal payments, usually equal monthly payments. Sometimes, for example, when I have for furniture or other things, some lenders will provide weekly installments. So, if the loan is made to a laborer who gets his paycheck weekly, usually the lender will provide for a weekly payment, for a weekly installment. These are used to buy sometimes cars, sometimes furniture, sometimes
Household products.
household products, we call it sometimes appliances, TVs, refrigerators, stoves, computers, electronics, whatever that might be. Installment loans. The next group is credit cards. Bankers loved in the early days credit cards because they could charge
Charges.
very, 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 very high fees and very high interest rates. And when the consumer was late even by 2 or 3 days, suddenly there was a penalty, late payment fee, penalty interest rate, and a whole bunch of stuff. And you owed $30 to the bank, and suddenly, out of fees and everything else, the $30 became $120. It cost you an extra $90. All right. And again, you're defenseless against the bank. So banks would love to see borrowers, credit card owners rack up debt. And of course, they would love to see, even for a minute, that the customer goes over the limit. And when it goes over the limit, again, over the limit fee and blah, 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 new interest rates and everything else. So you have, let's see how we call it, maximum limit, or credit limit. Credit limit, this is the maximum amount that the borrower is allowed to borrow from his credit card.
Yes.
As soon as you exceed it, there is a so-called over-limit fee. Over-limit fee is a punitive charge by the bank to the customer because he went over the limit. Well, this is just made to charge even more money from.
He can't go over the limit.
That's the key. He can't go over the limit because he can't.
Yeah.
But what the bank prefers to do is let him go over the limit and charge him 50% again, $50 over the limit fee. Because let's say your credit card is $940. And when it's $940, they put on the credit card, let's say interest for the month will be $40, so you're up to $980 with accrued interest. And he thinks he's got $940, he uses the credit card for $40 purchase, so he's $1,020. And suddenly the limit is $1,000, and wham, $50. So it turns out the $40 purchase cost him plus $50, plus the punitive interest. You know, the credit card suddenly switches from a, let's say, 14% interest up to 21% or whatever the legal limit is. And banks love this. This is the most profitable business of any commercial bank on a per capital basis. So whatever unit of capital is invested, this is definitely the most profitable, at least in good time. You have also annual fees. Annual, usually fixed. Annual fees. So this is what the bank charges a credit card holder for the privilege of having the credit card and the credit facility to charge up to the credit limit. All right? Banks have to comply with so-called usury law, which is a law imposed typically by the state of the maximum amount of interest which a lender may charge the borrower, maybe 19% in some states, 21% in other states, 25% in third states. Now, usury means what? Anyone have any clue what usury means?
Yeah, and no interest. Take interest, money.
Yeah, usury means charging interest. The original meaning comes from the Bible, Christianity, where the Bible prohibited charging of interest. And like Islam, and anybody charging interest by Christians back in the old Christian world will be charged with usury. In other words, he's committed sin. All right. Well, that was early on. Then Jews got in. Don't want to get into that. Eventually, it was recognized that charging interest will happen one way or another. You know, if people want to drink, they will be drinking. If they want to charge and others on the other side will be paying for the interest, they will do that. So what they did is, okay, interest is okay, but within certain limits. So if it's up to 10% per year, it's okay, all right? If people want to, lend money and the others are willing to pay, Let's do that, but let's make sure it is reasonable in the sense that let's make sure that the lender does not abuse the borrower, so that the borrower becomes in a terribly defensive situation where he accepted 50 or 100% annual interest because he was desperate for whatever reason. And things do happen. Sickness, disease, all sorts of things. Alright, so usury laws stipulate the maximum annual interest that a lender may charge a borrower is usually part of state laws. Alright? Let's see what's next. The next part of this whole thing, and in general for consumers, is called credit assessment. Credit assessment is an evaluation made by the lender of the borrower's credit worthiness in general, alright? So, it will first take into consideration his accumulated assets, will consider his earning power, will consider third sources of potential income, like what is his brother or father or family doing, and will assess, meaning evaluate the overall probability of returning the loan, in full, or will assess the potential losses and their probabilities. Alright, let's see what else. And based on this, you may have a credit analysis. Now, credit analysis is a detailed and rigorous procedure that attempts to make a full, complete, extensive assessment of the credit worthiness. Usually, for a retail customer, you do the assessment, which is relatively, let's call it, quick and dirty. All right? If he's going to be borrowing $800 to buy a laptop, you wouldn't bother that much. The cost of making a detailed analysis isn't worth the revenue on $800. Now, if he's going to be borrowing, let's say, for a house, you definitely will try to do it. All right? So, the bigger the loan, the more detailed will be the degree of credit analysis, and therefore you have all of these attempt to evaluate eventually credit risk. All right, credit risk. This is a risk associated with a loan. Yes, with a loan. All right. Sometimes. And let's do this as a separate section. Sometimes we call these personal loan. Personal loan. Alright? And, again, for the same. He can just do anything. He can go and take a vacation, go and buy a car. I mean, they're going to be relatively small. Buy a computer, buy a laptop, buy, big screen, TV, whatever they might want to be buying, just use it for expenditures, for food, to cover charges for the next 1 or 2 months, cover costs of Christmas, etc., etc. All right. Another big loan, actually one of the biggest in recent years, have been real estate loans, which we call mortgage loans or mortgages. Mortgages. So mortgage has, if I explained a long time ago, at the very beginning, 2 completely different meanings. One of a mortgage is the property which is mortgaged. The other one of a mortgage is the same as the mortgage loan. So the first one is the mortgaged property, the second one is the mortgage loan. In this case, when we say mortgages, because we're talking about loans, do we mean the loan itself? You probably know a lot. I don't want to spend a lot of time. banks have been big on, let's try to do this. Let's try to do this. Personal. Sometimes called individual. This is for a family to buy its own house, to buy its own. And they're also known as, let me do this trick, because I can, right? Residential.
Professor, when you say banks, you mean banks in the United States or banks everywhere?
I usually mean banks everywhere. This is what banks everywhere in the world.
But here in Saudi, they don't like personal loans.
Well, I understand.
They're not big on personal loans.
I understand. They're not big on personal loan for whatever reason here in Saudi Arabia. I can
Because they
understand.
take very risky.
Yes, I understand. What I'm saying is these are the typical loans, and depending on, let's say, number one, culture, philosophy of banking, philosophy of risk management, and expertise and everything else. Some banks will be huge on mortgages, others will be huge on corporate loans. In other words, I provide you the full mix of loans, kind of like, hey, this is we call it the loan portfolio. You're going to have a little bit of personal, you're going to have mortgages, you're going to have consumer loans, you're going to have corporate loans, you're going to have some other loans, and I can go back along the list. Well, in Saudi Arabia, you like for whatever reason, so you will shrink the consumer loan to a minimum, and you're going to have a bigger slice of the pie into corporate. Alright? So, again, all I'm trying to say, what is what it means, when they use it, how they use it, and just because it is not big here in Saudi Arabia doesn't mean you shouldn't know it, because it may be big elsewhere in the world, whether it's China, Japan, US, or Bulgaria, right? So, you should just understand the concept as it is. Now, much bigger in much recent years, and of course residential mortgages in the US, all across Europe, including Eastern Europe, are blowing up big time because we had a big real estate bubble in the last 4 or 5 years. And now we are getting due for the blow up of the other mortgage sector, which is called commercial. So, examples of commercial real estate. So, commercial mortgage is a mortgage used to finance commercial real estate. Example will be corporate offices, maybe parkings. The big one in America, Bulgaria, here is shopping malls, right? All of those, in other words, this is real estate which is not used where people just sleep for their own. So commercial will be hotels, all right, because it's used for business purposes, all right. So commercial has become in recent years big, really big, because as the real estate bubble was inflating on the residential side, later on began the commercial real estate bubble. It blew up to big proportions, and now that the commercial bubble began a couple of years, 2-3 years later, it is naturally blowing up today, 2-3 years later, after the residential. Let's see what else we got. Wow. This section is done. So, next thing is 3. Next, so, cash loans. So all I was covering now is different types of loans. Now we move to 3, which is fairly straightforward. Securities, or investment in securities. Well, sometimes banks will hold corporate bonds, okay? Nothing wrong with that. Occasionally banks will hold stocks. Some banks or some laws prohibits certain banks or commercial banks from owning stock. Because once you own stock, you begin to exercise influence or control over the corporation. Usually involves power every time bankers are given certain power, they love to
abuse it.
use it and abuse it every time they can. So some laws prohibit commercial banks from owning more than a small percentage of, of the overall share base of whatever. I don't want to get into that. So what else do they own?
What about government security?
These are the big ones. They are the biggest one. Treasury notes, bonds, etc. Bills. Banks love them because they're very stable, very secure, practically zero default risk, zero risk of default. And the most important, which is for the bank, is liquidity. They use those securities to manage liquidity. In other words, when they aren't so really sure if they're going to need the liquidity or not, rather than keep it in liquid cash, they will keep it in some sort of a very perfectly low risk and liquid, and it's also going to be short-term liquid government bond that they can easily sell and convert into cash immediately. They also like the GSE securities. You know what's GSE? Government-sponsored entity. These are Fannie Mae, Freddie Mac, Ginnie Mae. These are the ones that usually have some sort of a government sponsorship. In other words, usually they are private institutions, privately owned institutions that may or may not have a explicit government guarantee. That was up until a few months ago, until Fannie Mae blew up and actually the government took over the ownership, and from a legally and technically purely private institution with some implicit government backing, the implicit government backing became explicit and the government took over because it went bankrupt. And it was considered to be too big to fail. That's a whole different topic altogether. Alright, they will also hold...
Fannie Mae, is it for commercial mortgage?
We may discuss it part of residential, part of GSEs, as part of, in general, financial institutions. It's a special type of financial institution, which I don't want to get into the section of commercial banking and to Fannie Mae, Freddie Mac and all those. But if you get into the residential side, usually in securities on mortgages, you will read a full chapter on Fannie Mae, Freddie Mac and all the details. They also like to hold municipal bonds, municipal securities. These are securities issued by state and local. We call them non-federal, state and local, non-federal. Sometimes these are tax exempt. We discussed this before. All right. Another is Fed funds sold. Now, Fed funds sold simply means, if you remember from previous lecture, banks will have Fed funds bought, and Fed funds bought is equivalent to borrowing and represents a liability for the commercial bank, and Fed funds sold is essentially an asset. It represents a loan of one commercial bank to another commercial bank of its Fed funds, of its deposit at the central bank for minimum reserve requirement, usually transaction fees and whatnot. Number 5 will be repos. These are repurchase agreements. You understand, just like on the one side the bank did a repo and borrowed money, the repo, the counterparty would be possibly another bank, so another bank will effectively have executed a loan through a repo, which is the buying or selling of a security with the repurchase. All right. The next one will be 6 Eurodollar loans. These are potentially owners of Fed funds sold is tiny little portion of the overall portfolio. Probably Fed funds will be as big as this one, and the idea there will be very simple. They'll use this to manage minimum reserve requirements and liquidity. If they need a little bit more to meet reserve requirements, they'll borrow it. That was on the liability side. If they have a little bit of excess reserve, they'll lend it out possibly overnight.
Yeah.
You understand
Yeah,
what overnight means?
Yes.
What does it mean, overnight?
The time that they're not.
What's the duration usually of bank loans?
Yes.
It's quicker.
It means for 1
Yes.
day. So it is loaned out for 1 day. All right? It is loaned out from 1 business day
To another.
to the next, not to another, to the next business day. All right. And banks will use number 7. I will not write it because I ran out of space. They will use in fixed assets. Banks will own a building, right? This big flashy building with which they impress so well their customers. And the building is what leaves the impression of the customer of the stability and reliability of the bank. Usually, the bank accomplishes with flashy advertising and grandiose buildings. When the customer sees a really big, flashy, grandiose building, he gets to think that the bank is really reliable, while the opposite could possibly be true. The bigger and the more grandiose the building, this means that the more money the bank spent out of the customer's money into the building, and the less it used to make real money out of it. Okay, and with this, we take a little break.